In this video, I will be looking at how you can protect your portfolio during a market crash and finding out which is the best option for you. This is Mark from TradeInformed.com, and this is the second part of a three-part video into how you can make sure your portfolio thrives no matter what the markets do. If you would like to see the first video in this series, there is a link on the screen and down below for you to click on. In this video, I'm going to be looking at different ways to hedge your portfolio and how to select the best way for you. Throughout this series, I am using the SPY Spider ETF, which tracks the performance of the S&P 500 index, and I am using it with dividends reinvested to accurately reflect how capital has accumulated over the 25-year time period. On the screen at the moment, we have a spreadsheet which is showing the results of a hedged portfolio. We have the SPY here, this graph down here in white, which is showing the SPY performance over the past 25 years from 1993 to 2018. And we have here the two significant bear markets of our times, the dot-com fall of 2001 to 2 and the financial crisis stock market crash of 2008 and 2009. Both of these were significant drawdown, not just in terms of the value that was lost, but also the number of years it took for the portfolio to recover. So we have here below the market, what we have here, and you will know this if you have watched the previous video, is our hedged portfolio. And this is the performance over time, over 25 years. And significantly, we can see that the hedge is doing a reasonable job. We can see here that in the relatively slow bear market of these years, it kept us out pretty well. Also, of the faster bear market of the financial crisis, again, it's done a reasonable job, but it leads to the question, is there a better way to hedge rather than just go to cash or to do something else, purchase an option or an inverse ETF when the market is below the 200 moving average? Well, I've looked at a couple of options. And the first one is using the golden cross. Now, this is a 50-200 moving average cross. And this is a pretty well-known trading strategy. So we would be invested in the market when the 50 period average is above the 200 period average. And not going into too much detail about the strategy yet, it is quite possible, quite obvious that the net profit here is better than in the EMA only strategy. And I'm going to click on this button here, and what that does is gives me another comparison over here. And this is the golden cross. And now we're starting to get a few different strategies to compare. We can see that net profit from buy and hold, which is very respectable over this time period, 9% compound annual growth rate, is actually better in the golden cross scenario. Our profit factor, which is a measurement of the absolute value of gross winning trades divided by gross losing trades, is much higher. And the reason for that, and why I think this is a better hedging option, is the difference between the number of trades here, which is 86, and the number of trades here, which is 10. And I'm simply interested in the fact that there are far fewer trades in the golden cross. In other words, we're getting far fewer signals, so we are not getting the signals as quickly, but we are getting them. When we do get them, they are going to be reliable. And over time, this has proven to be a more effective way of hedging. If I go back to the results tab, we can have a look at some other factors in the golden cross hedging strategy. We can see in particular the max drawdown is a lot lower than buy and hold. And if I wanted to equalize this, which is a theoretical test to see how much extra drawdown we can get by increasing the amount of leverage we're using in our strategy. So if I wanted to double it, we're using 2-to-1 leverage. We can see that our max drawdown is still a lot lower than buy and hold, whilst returning a much higher level of net profit. And once again, theoretically, I can increase it significantly higher yet, and we're still not seeing the level of drawdown. I'm going to put this back to 1. Now I've got another type of hedging strategy, and this is using the linear regression line. The linear regression line, as you can see on the screen at the moment, is the best fit straight line through a series of price data. And this is commonly used by traders to create standard deviation channels. I also use standard deviation channels, but I particularly like the linear regression line because it gives me a long-term market direction. It is slow to move, and so I'm not going to be whipsawed in and out of the market. So in our linear regression hedging strategy, I'm going to be buying whenever the linear regression line is pointing upwards above the horizontal. I'm going to be long, and I'm going to be neutral whenever the linear regression line is pointing downwards. And back to the spreadsheet, we can have a look at how this performs over time. And we can see here that again it is performing very nicely, and we can compare them again, copying the strategy results over here, and I'm just going to call this one linear regression. And we can see here that even compared to the golden cross, we actually have 1 fewer trade and we have 2 fewer losing trades. So our profit factor is very high. More importantly, our net profit is on a par with, although slightly higher than golden cross and higher than buy and hold. A percentage of winning trades in this form of hedging is 88.9%. Compound annual growth rate of over 10% per annum. And a maximum drawdown is identical to the golden cross strategy. So once again, if I go back to the results, I can theoretically look at what the strategy would be like with greater amounts of leverage. And once again, it performs pretty nicely. Selecting this back to 1-to-1 leverage, we can have a look here at the actual trade lists, and we can see that a huge proportion of the trades a huge proportion of the gains came from one trade between 1994 and 2000. And this is often going to be the case. We had a roaring bull market that lasted for a long period of time, and this is where we made our money. However, since then, since 2000, since the financial crisis crash, we've also done very well, cumulatively over 100%. So over this time period, we can see that the linear regression hedging strategy has performed, along with the golden cross hedging strategy, has performed the best. It has performed better than buy and hold. It has avoided a very large part of the potential drawdown that would otherwise have been incurred. If you want to make this strategy more specific to the markets that you trade, the spreadsheet that is you have seen on the screen is available at tradeinform.com, and there is a link on the screen or below for you to get more information about that. In the next video, I will be looking at how these hedging strategies have performed over time. I will be doing a walk forward analysis to say it's all very well looking from 1993, but what about if we're starting from different time periods? At the moment, it would appear that we are running into some market volatility, and we want to know how these hedging strategies have performed under similar market conditions. And I'm going to be doing this with a walk forward analysis. I hope you enjoyed this video. Please remember to hit the like button. Also subscribe to this channel if you want to see more content like this about helping you to analyze your trading strategies and get real data about how the markets perform. If you want more information about trading the financial markets, about how to analyze and backtest your own trading strategies, please go to www.tradeinformed.com.